Hi guys, it's Stock Curry, and today we're going to talk about two more catalysts for a market correction. I'm also going to talk about whether the market correction might have actually already started and how you can make money during it. I've also got a few stock picks for you guys, so let's get into it. Okay, let's start out with another sign that the stock market is overvalued and quite possibly due for a major market crash here soon. And that is the IPO markets. There's an old correlation in the IPO markets between the number of IPOs and how overbought or oversold a stock market is. Generally speaking, when you see a high number of IPOs, it generally points to a stock market being overbought. And when you see a low number of IPOs, it generally points to the stock market being oversold. And that kind of makes sense. If you own a company and you want to do an IPO, the whole point is to raise cash. And the best time to raise cash is when you're in a market that's very, very high, where you can get the most amount of money for your stock. You don't want to go out and do an IPO when the stock market is beat down, because you're not going to get a lot of money for your company. And so it makes sense that you're going to see a high number of IPOs when the stock market is overbought and a low number of IPOs when the stock market is oversold. And taking a look at what's going on in the IPO markets right now, June of 2021 was the busiest month for IPOs in 21 years. And of course, what happened 21 years ago? The dot-com bubble burst and the market crashed. So the IPO business is another indicator that this stock market is overbought and we are about to have a major market crash. Okay, now I want to talk about a short-term catalyst that could trigger a correction in the short term, which could lead to a larger crash down the road. And that is earnings. Earnings season is here. We are in the midst of it. And this past week, we saw quite a few banks report earnings. Now, here's what was interesting. Going up into earnings, the banking stocks were up. And when they reported earnings, they went down. Here's the crazy thing, is that the banking stocks actually beat earnings. So why did the stocks go down? The reason is because going into earnings, leading into them, the banking stocks were up massively. People were expecting these blowout earnings with banking stocks, and in reality, they just kind of beat earnings a little bit. And so when they didn't have blowout earnings, the banking stocks actually went down after earnings. And I think we're going to see the same thing happen with these large cap stocks. Keep in mind that over the past few weeks, the stock market indices have shown that the stock market has gone up. But in reality, that is only because of a few very large companies, these trillion-dollar companies, these large cap tech stocks, Amazon, Apple, Microsoft, Google, stocks like that have been rising, that have actually caused the indices overall to go up. The reality is most stocks have actually gone down. And what is coming up is in the very last week of July, in a little over a week here, we have all of these large cap stocks that have been rising recently. They are going to be reporting earnings. Tesla reports earnings on Monday, July 26th. Apple, Microsoft, Google, and Visa all report earnings on Tuesday, July 27th. Then we have on Wednesday, July 28th, Facebook and PayPal. And then on Thursday, July 29th, we wrap it up with Amazon and MasterCard. Now, all of these companies have been running up massively going into earnings in anticipation of these huge blowout earnings. And I think that they are going to sell off hard after earnings. So starting Friday and throughout next week, I am going to be buying hedges against a drop in the market. And in today's video, I'm going to show you what those hedges are and what you can do to also prepare yourself for a drop in the market that may be coming up. All right, let's get into today's stock picks. For those of you who are new to this channel, my name is Stock Curry. I used to work as an analyst for some large investment banks, and now I analyze stock picks from the top 10 YouTubers. Every day, I watch hours of YouTube videos from the top 10 YouTubers, and then I consolidate all of their stock picks into a single video, and I give you the cliff notes on all of their stock picks as well as my analysis on their stock picks. Now, all I ask for putting all of this together for you guys is that you hit that like button, subscribe, click the bell icon, and then click all so that you can get notified when I release my next video. If you're watching on Facebook, go ahead and follow the page also. In fact, I'll give you guys 5 seconds to do all of that right now. Alright, before we get into today's stock picks, I just want to remind everyone that I am not a financial advisor and none of the YouTubers I analyze are financial advisors either. Nothing I talk about today is a recommendation to buy, sell, or hold. These are just my opinions which may or may not be accurate. Please do your own research before investing in any asset. Now if you're wondering what you're looking at right now, this is the Webull desktop app. Webull is the app that I use for my trading and it is also the app that I use in all of my videos. Alright, let's get into today's stock picks. And first up is AAPL. This is Apple. StockMo listed AAPL as one of the 5 best non-EV stocks to buy now. It should be noted that StockMo purchased AAPL earlier in the year and he is currently just holding. He does have a 1-year $225 price target on AAPL. In the short term, AAPL remains overbought and I do expect a pullback soon. Next up is ABNB. This is Airbnb. StockMo listed ABNB as one of the 5 best non-EV stocks to buy now. He thinks as people start to get out more and travel, that using Airbnb will become a norm in the future. StockMo likes ABNB as a long-term hold. He said he really likes buying stocks near the 12-month lows for long-term holds. I will tell you that technically ABNB remains quite bearish. I would not be comfortable buying in yet. I would wait for a sign that ABNB has bottomed out before buying in. And next we have AMC. This is AMC Movie Theaters. Keen and Grace discussed AMC's failure to deliver or FTD data. The FTD data for the second half of June came out today and wow! These numbers are huge! Now keep in mind when you're looking at these numbers that these are rolling numbers, meaning you can't just add up all of these numbers together. The values of the total failures to deliver shares represent the aggregate net balance of shares that failed to be delivered at a particular settlement date. Fails to deliver on a given day are cumulative numbers of all failures outstanding until that day, plus new fails that occur that day, less fails that settle that day. The figure is not a daily amount of fails, but a combined figure that includes both new fails on the reporting day as well as existing fails. It's also important to note that the age of the fails cannot be determined by looking at these numbers. Okay, now that you understand how the failure to deliver numbers are reported, let's talk about how these failure to deliver numbers are proof of massive market manipulation on AMC. If you correspond these numbers to the stock prices each day, what you will notice is that anytime the stock price got above $60, we saw a massive number of failures to deliver. For example, back on June 3rd, when we had over 5 million failures to deliver, the stock price was at $62.55. It then went quiet for a while, and then on June 18th, the FTDs shot up to over 2 million all of a sudden. The stock price rose from $55 the day prior to $60.73 on June 18th. The spike in FTDs perfectly matches up with the share price. The lower the share price, the less FTDs we see. The higher the share price, the more FTDs we see. So why does this matter? Because failure to delivers mean a market maker accepts your money for a stock, but does not actually buy that stock on the open market. Instead, they give you an IOU for the shares and it gets recorded as a failure to deliver. The reason market makers do this is to keep the share price down. By not buying the shares on the open market, there is less buying pressure on the market and then there are fewer buyers, then the price goes down. The market makers then continue to fail to deliver the shares to you until the price drops. And then they can buy the shares on the open market at a much lower price than what you paid. Not only does this greatly increase profits for market makers, it also manipulates the markets by artificially keeping the price down. Now to correspond that with a chart, let's take a look at what happened on June 3rd and June 18th. Now just keep in mind that the failure to delivers are reported for the day after. So what we really have to do is we have to go back and look at what happened on June 2nd to see that huge spike in failure to delivers on June 3rd. And then we have to look at what happened on June 17th to see that huge spike in failures on June 18th. Now I've added another horizontal bar in purple here so that you can see what happens every time the price gets above $60 on AMC. So here we are on June 2nd and the stock price rose above $60 for the first time. And then on June 3rd, we see the massive spike in failure to delivers as market makers try to push the price down. And in fact, we can see that they were successful in doing that on June 3rd. The price then stayed below $60 all the way up until June 17th. On June 17th, it rose above $60 again. And sure enough, the next day on June 18th, we see a massive spike in the failure to delivers. Once again, market makers try to push the price below $60 on June 18th, and they were successful in doing that by using failure to delivers. This was all an attempt to keep the price below $60 so that market makers would not have to have a huge gamma squeeze on their $60 and above call options. So you can see the stock price, you can see the failure to delivers, and you can see the massive correlation between a spike in AMC above $60 and a spike in failure to delivers the very next day. It is a sign of massive market manipulation, and there's no other way of looking at it. Now, the one good news we have is that because AMC had these massive failure to delivers for more than 5 days in a row, it actually ended up on the SHO restriction list, and so this is actually going to be investigated by the SEC, and hopefully we see some change or some fines or something that comes out of this whole fiasco so that this sort of thing never happens again. Okay, next up is DIS, and this is Disney. StockMo listed DIS as one of the 5 best non-EV stocks to buy now. StockMo likes DIS as a long-term hold. StockMo just got back from vacation to Disney World, and he said the parks were packed, and he thinks the parks are doing just fine. He also likes the fact that Black Widow came out and had the highest grossing opening of any movie in 2021. A large portion of Disney's Black Widow revenue came from Disney+, and StockMo likes everything about DIS and thinks it will continue to go higher. I agree that DIS should be a great long-term hold stock. It was a little overbought a few months ago, but it has since come back down to a reasonable price. A few months ago, I'd given a $187 buy-under price and a $180 ideal buy-in price. We are in that range now, so I think now is a great time to buy DIS. Next up is DKNG. This is DraftKings, and they're an online sports betting company. StockMo bought more DKNG today. He thinks DKNG might have bottomed out. StockMo likes DKNG for a long-term hold. He thinks DKNG is going to be the leader in online gambling, and DKNG should also perform well as more and more states legalize online gambling. Now, technically, DKNG is showing signs of being oversold. The candles have closed below the 300-day EMA twice now, and the RSI is very near oversold. So I agree with StockMo that this one does look like DKNG is near a bottom, and it might rebound soon. Next up is GS, and this is Goldman Sachs. You can see on this chart how Goldman Sachs was rising up, and then it sold off after earnings, despite the fact that they blew earnings out of the water. StockMo listed GS as one of the 5 best non-EV stocks to buy now. GS is a banking stock and a great hedge against higher interest rates. It's also cheap right now with a PE ratio of only 6.82 and a forward PE ratio of only 7.87. At the current PE ratio, GS is a solid value stock. StockMo likes GS as a long-term hold, and I also like GS, and this is actually one of the stocks that I own. Next up is NIO. This is NIO, and they're a Chinese EV manufacturer. StockMo bought more NIO yesterday. He thought it might have bottomed out. With today's bounce, it does look like there's a chance that Wednesday was the bottom. NIO could be bouncing off of the 100-day EMA, but we'll have to wait until Monday or Tuesday before we get confirmation of a bounce. To confirm a bounce, we'll need to see NIO stay above the 100-day EMA, and we'll need to see the MACD histogram continue to rise. Next up is STEM. This is STEM, and they use AI to optimize energy usage by automatically switching between battery power, on-site generation such as solar, and grid power. StockMo listed STEM as one of the 5 best non-EV stocks to buy now. StockMo thinks STEM can take advantage of some of the clean energy spending that is part of the infrastructure bill. And he also thinks STEM will continue to do well in the future as more and more money is invested into renewable energy. StockMo bought more STEM on Thursday. STEM has been in a downtrend for the past few weeks, but it does look like it might be close to bottoming out. STEM is approaching the 200-day EMA, which has historically been a level of support for STEM. STEM is also nearly oversold on the RSI. For a long-term hold, I think you are fine buying STEM at the current price. I do see the bottom at somewhere around $25. Okay, I want to finish my video with some ways that you can hedge against a stock market crash or stock market correction. And the first one is SPXU. This is a 3 times leveraged inverse S&P ETF. So if you think the S&P is going to go down, then you can buy SPXU, which will go up when the S&P goes down. Now, the one thing I need to warn you about is that these 3 times leveraged inverse ETFs are designed to go down over time. The way these work, they are very, very expensive to maintain, and so they lose a lot of money over the long run. So you should only buy SPXU as a very short-term trade. Usually I do not like investing in this for more than 1 week at a time. And SQQQ is very similar to SPXU, except it's an inverse ETF on the NASDAQ instead of the S&P. And so if you think the NASDAQ is going to go down, you can buy SQQQ. Again, this is designed to go down over time, so I do not recommend holding this for longer than 1 week at a time. And the last stock market crash or correction hedge that I want to talk to you guys about is UVXY. You could also mix this in with VXX, which is very similar. Like our other hedges, this is designed to go down over time, so I do not recommend holding this longer than a week. UVXY is a little bit different from SPXU and SQQQ because this one goes up when the VIX goes up. VIX is a volatility indicator, and the VIX goes up whenever the stock market goes down. You cannot trade the actual VIX, but you can buy UVXY, and UVXY will go up if the market overall goes down. So unlike SPXU, which is a play on the S&P, and SQQQ, which is a play on the NASDAQ, UVXY is a play on the overall market altogether. Alright, I hope you enjoyed this video and got a lot out of it. Comment down below if you think a market correction is coming soon and what you are doing to prepare. And if you're looking for a broker to trade with, you can sign up for Webull using my link in the description below. When you sign up using my link in the description below and deposit just $5, Webull's going to send you 2 free stocks worth up to $2,300. And if you're not a US resident, or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers is an incredible platform. They have commission-free tradings in the United States and highly discounted trading throughout the rest of the world. And both Webull and Interactive Brokers offer the full pre-market and after-hours trading from 4 a.m. all the way to 8 p.m. Eastern Time. Now, I do have material connections with both Webull and Interactive Brokers, so when you sign up using my link in the description below, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos. Now, don't forget to hit that like button, subscribe, and click the bell icon or follow the page if you haven't already. I hope you have a lot of success trading, and I will see you tomorrow.